Do you want to give a little brief history of like what the Yale model was and why
Sure.
it's important?
Yeah. So the Yale model's been around since the late 1980s. It was really pioneered at Yale University. They, at the time, I don't have the number in front of me, but they had an endowment fund that they were managing at Yale. It was maybe a couple $1 billion, 1 or 2 billion. I think today it's over 30 billion, somewhere in that range. But a guy there by the name of David Swenson was the guy running that endowment fund at the time in the late 1980s. He recently passed away a year or two ago, but he ran that endowment for, 35 years or so, 30 to 35 years. And he really pioneered this endowment model concept of mixing both stock and bond strategies along with private asset investment strategies. And he did it super successfully. I think his rate of return that he compounded the Yale University Endowment Fund over that 30 plus year history was like about 13.5% compounded.
Wow.
And I think he really did it while minimizing risk and maximizing kind of diversification. And he was really the first one to really heavily start to invest in all these different categories: private equity, real estate, infrastructure. And I think it's also allowed Yale and other institutions that started to copy it pretty quickly, to really weather through some of the storms that you've seen in the last 30, 40 years with the stock market, where they tend to lose a lot less money when the stock market's been down 20, 30, 40, 50%. And you look at the returns of these large institutional investors like Yale. And it's all visible. You can Google it. They all publish investment reports.